Hello, YouTube. Thanks for tuning in to the next installment of All Things Trading, the multi-part series dedicated to those who are looking to get started trading in the financial markets, or perhaps have been trading for a little while and just not very good at it. We're going to address all of that in this series to help you become wildly successful. So don't forget to hit the subscribe button so that you can stay on top of all the fresh content that is going to be dropping. And now that you know what type of trader you want to be, let's talk a bit about what exactly is the stock market anyway. So here's what's on deck. For this episode, we're going to talk about the stock market and the purpose that it serves, the various exchanges and what their role is in all of this. We're going to talk about exactly what a stock is and a whole lot of initials that go along with trading in the financial markets like OTC, IPO, etc. And of course, the role that your broker is going to play along with other people or entities that you are going to be either working with or working against. But before talking about what the stock market is, we should first talk about what a stock is, otherwise known as an equity. Well, simply put, a stock is a piece of ownership of a company or corporation. And when you purchase a stock, you own what is referred to as a share. So if you were to purchase 10 stocks of Apple, you wouldn't say you own 10 stocks of Apple. You would say that you own 10 shares of Apple. Think of a company's ownership as a giant pizza. But instead of 8 slices, there's 100 million slices. These slices are referred to as outstanding shares, or the number of shares that are out there in the open market. And let's say a company's share price or stock price is $100. Well, if there's 100 million shares outstanding and each one of those are worth $100, well, that is a $1 billion company. Now, that figure is what's referred to as a company's total market cap. Now, these outstanding shares can fluctuate. A company can issue additional shares in an effort to raise more capital, which would increase the number of outstanding shares, or they could issue a stock buyback, which would decrease the number of outstanding shares. The effects that those actions would have on the actual stock price, we'll get into that in a separate video, but I think you get the idea. The stock market is not an actual market. In fact, the stock market is not a physical place at all. The stock market is a collection of stock exchanges that exist all around the world. And it's at these exchanges is where the transfer of stock ownership takes place. But first, a company must apply and meet certain requirements in order to have their stocks listed on that exchange. An example of an extremely popular stock exchange would be the New York Stock Exchange. And on that exchange is where you will find companies like General Motors, Bank of America, Carnival Cruise Lines, just to name a few. Another very popular exchange would be the NASDAQ. And on that exchange is where you would find companies like Apple, Intel, and PayPal. Again, just to name a few. And there are many more exchanges than just these two. I mean, you've got the London Exchange, you've got the Tokyo Exchange. And if you're interested in knowing how many exchanges there are and where they're located, I imagine a simple Google search would satisfy that. But in the effort of keeping this in short, bite-sized chunks, I'm just going to give you the gist of what's going on behind the scenes. Now, these exchanges play a very important role. They are responsible for facilitating the buying and selling of these stocks. They are highly regulated by a local government entity. Here in the United States, that entity is the SEC, or Securities and Exchange Commission. Each exchange has their own unique list of criteria that a company must meet in order to have the privilege of having their shares listed on that exchange. This list is going to vary from exchange to exchange, just like any other business, but it all boils down to the same thing, more or less. How big of a baller are you? How many shareholders you got? How much money you make? What's your total market cap? And at one point, companies like General Motors and Yum Brands and Walmart and Carnival Cruise Lines, Bank of America, and many, many more have all said, pick me, pick me. But even after meeting that criteria and submitting the application, the exchange can still reject them for whatever reason they feel like it, I suppose. But if a corporation is fortunate enough to be accepted by that exchange, they do not rest on their laurels. Because if at any time that corporation's performance is deemed to be subpar, the exchange can also delist them. Now, I rattled off a couple of names of corporations, and if you're following along, you'll see that that is not what appears on your screen. These initials that you see are what's referred to as ticker symbols, and they are unique to an individual corporation, and it is how that corporation is identified on the exchange. So why go through all of the hassle? Well, for the company, having your shares listed on an exchange is a fantastic way to raise capital, to expand, or do whatever your business does on a grander scale. And it is also a good alternative to a bank loan because raising money through the stock market, you're not incurring any debt. For traders like you and I, that gives us a perfect opportunity to share in a company's profits in the form of dividends or selling the shares for profit at a later date. Wait, hold up. What's a dividend? A dividend is a distribution of a company's profits to its shareholders. This payment, depending on the organization, can be paid on a monthly basis, it could be paid quarterly or annually. The payment is usually made in cash, but it could be paid in the form of stock. And how much you're going to get is all about how much you got. So the bigger stake you have in the company, the more of a dividend check you can expect. But take caution because not all companies pay a dividend. So if that's what you're looking for, make sure that the company you are investing in actually pays a dividend. Otherwise, you'll dump $5,000 into a company and then a year later wonder where your dividend check is just to find out that they don't pay dividends in the first place. And then there's the old-fashioned way. Buy low, sell high. Well, that's easy. If you got $5,000 to invest in a company whose stock price is $100, well, that's going to get you 50 shares of that company. And if at a future date that stock is determined to be valued at $150 and you sold your 50 shares, well, then that's going to get you $7,500. Subtract the $5,000 in seed money and You got yourself a $2,500 profit. But what if the stock doesn't go up? Can you still make money? Yep. What if it goes down? Can you make money then? You sure can. Now, there are a variety of option strategies, short selling. There's a multitude of strategies that can make you profitable in the markets regardless of what direction the stock price goes. And that is going to be in a whole separate set of videos. So stay tuned. The best is yet to come. So how does all this get started? Well, it starts with a company deciding to go public. And going public essentially means that a privately owned organization will become a publicly owned organization for reasons I've just mentioned. And that all starts with the IPO, or initial public offering. Now, there is a whole lot involved in the IPO process that I'm going to get into on a separate video. But the nuts and bolts of it are this. When a company decides they want to have an initial public offering, they will first contact an investment bank. That investment bank, through its underwriting process, is going to determine a few things. What the company is worth, how many shares are going to get put out there, and at what price. This investment bank is also responsible for getting the word out there. Hey, XYZ company's been around a long time. They're doing great things. They're about to explode. Get in while the getting is good, and at a discounted price to entice would-be investors. That is not the phone call that you and I get. These are the big boys, the hedge funds, the institutions. Warren Buffett's cell phone is ringing at this point. Because you see, those folks live in what's called the primary market. These are the guys who get first crack during this fundraising phase. And after all of that dust settles, then the doors open for you and I. Because we live in what's called the secondary market. And that's where all the trading of these stocks will take place. And, there's lockup periods and SPACs and all kinds of other stuff too, but we'll get into that in a separate video. But remember those listing requirements that I was talking about? What if a company goes through this process and doesn't meet those listing requirements? When a company does not meet the listing requirements of an exchange like the New York Stock Exchange or the NASDAQ, they are traded over the counter, or OTC. Now remember, the exchange is where the transfer of ownership takes place. But if they can't get on the exchange, then how does that work? Well, with OTC stocks, the transfer of ownership would take place through a dealer broker network or a market maker. We'll talk more about that later. But because they don't meet the listing requirements, they're not held to the same reporting standards either, which inherently make them more risky. I mean, because of this, they don't have the higher price per share that the larger companies would, which is good for you because you can get in on something on the cheap. However, you're investing in something that you don't have all of the information that you should in order to make an educated trading decision, particularly about the company's financials. And because of low trade volume, there's less liquidity in OTCs, resulting in a larger bid-ask spread. You're probably saying to yourself, huh? Yeah, you're going to know what bid-ask spread means soon enough. But just take caution when coming across these OTC stocks. Okay, so we talked about stocks. Now I want to talk about ETFs, or exchange traded funds. An ETF is a group of stocks that trade just like them, and they offer a safe haven, if you will, from what could be extreme volatility in an individual stock. See, if you trade Apple and only Apple, see what I did there? Apple, and they're having a bad day, well, then you're going to have a bad day. But just because Apple is having a bad day, that doesn't mean that Microsoft is having a bad day. So when you have a group of these stocks or a basket of these stocks that contain Apple and Microsoft and 10 other tech giants, when one of them is having a bad day, you have 11 others in there that can pick up the slack. That results in a lot less volatility, which in turn would make ETFs slower moving. You can decide for yourself how you feel about that. But an ETF also serves as a pretty darn good indicator as well. Because if you've got an ETF that's got 12 tech giants in it and all of them are going bad, well, that's a pretty doggone good indication of where the entire industry is headed. So what's your broker's role in all of this? The broker is the middleman between you and the stock exchange. You cannot walk into the New York Stock Exchange and say, yes, can I get 25 shares of Bank of America, please? You need a broker for that. There are full service brokers like Fidelity and Merrill. And then there's budget brokers like E-Trade and Robinhood. Budget has a negative connotation to it, but it's not necessarily a bad thing. The difference between a full service broker and a budget broker would just be in the amount of services that are provided. Fidelity and Merrill would offer retirement planning and investment advice, etc. But if you're trading with Robinhood, try getting a hold of someone at their headquarters and getting some stock picks. Now, within these brokerage firms would be different types of brokerage accounts, whether it's a standard account or margin account. We're going to get into that in a separate video. But the bottom line is that when you're trying to sell something, your broker is going to match you with a buyer. And when you are wanting to buy something, your broker is the one that's going to find that seller. So, what did we learn? We know that when a company goes public, they're getting listed on the exchange or going OTC. Your broker is the one responsible for matching you with a buyer or seller. When you buy a stock, you own a piece of that company or a share, and you can sell those shares whenever you want. And the exchange, well, they're there to make sure that everything's cool. Well, you made one more step in your journey to mastering the financial markets. If you have any questions about the content in this video, leave them in the comments below and I will be sure to address them. If you found this information useful, please hit the like button. The split second it takes to do that means so much to me and my channel. And when you subscribe, don't forget to hit the bell icon. That way, when fresh content is dropped, you know about it. Thank you so much for watching, and until next time, stay profitable.